Today, we're going to talk about reverse mortgage, which I feel is the most misunderstood mortgage out there. And we'll talk about why. But first, I want to go ahead and kind of define what it is, the features of it, the myths that have been kind of associated with it, and the facts that really back that up. The proceeds, how one comes to know how much they're going to receive and how they receive it, as well as how they may have the option of paying it back at any time. There's two different types of reverse mortgages. We'll touch on that. And we'll go ahead and kind of finish up on who would be a good candidate for a reverse mortgage. So let's go ahead and just get started. With that, though, I try to keep these videos, no more than 5 minutes. This one's going to run long. And I'm going to do that because I think, like I said, this is such an important topic. If folks actually knew the truth, if you will, about the reverse mortgage, I think it'd be more utilized product for a lot of people. So in that vein, let's go ahead and get started. The home equity conversion mortgage, or the HECM, home equity conversion mortgage, is the formal name, the original name of the reverse mortgage. And that reverse kind of ties in with that conversion aspect of it. It allows for retirees to simply convert a portion of their equity, not all of it, but just a portion of their equity. And it also comes with some kind of flexible payback options for that same borrower. The loan itself is more like a conventional loan or a straightforward loan. I'll go ahead and kind of explain the similarities. In both scenarios, with reverse as well as a traditional loan, there is a lien on the property. The borrower maintains the possession of the home as well as the deed of the home. You can use these mortgages for a purchase or certainly as a refinance. There's no prepayment penalties with a reverse mortgage, much like a traditional mortgage. You can have a fixed or an adjustable rate reverse mortgage as well. And the borrower is responsible certainly for paying the property taxes and homeowners insurance just to ensure that the structure, the asset is safe and insured. And then also, along with traditional mortgages, you can purchase a single family residence, 2 to 4 units. You can purchase a condo. Many different types of asset, classifications do qualify for the purchase with a reverse mortgage. So the similarities are certainly there. There's a few differences, however, and one of the first differences is with a traditional mortgage, you have typically a responsibility to qualify for it. So you may need to have a certain credit profile, a certain FICO score. And that's not necessarily the case with reverse mortgage because essentially you're not expected to pay back the mortgage in the traditional terms. You don't have a monthly mortgage payment unless you choose to. The next one would be with a traditional mortgage, there is obviously a monthly payment associated with that. You borrow money, you pay back the money. And again, with the reverse mortgage, you have the option to go ahead and make a mortgage payment and kind of hold on to your equity position in your home for that month if you choose, but it's not required. And then the last one, as far as the differences between the two, is with the traditional mortgage, you have a fixed term. Say, for example, you might have a 30-year fixed mortgage. And there's a specific time, especially when it's amortized, when that actual loan will end. Well, with a reverse mortgage, there is no term amount per se, simply because you're not making or don't have the option, I should say, the responsibility to make a monthly mortgage payment to fruition. It's kind of an open-ended situation. We'll talk more about that and why that's the case. As far as the myths that we hear and the facts behind it, you might have heard them yourselves. That the first one would be that somehow the reverse mortgage puts the homeowner in jeopardy, that they may lose possession of their house. And that's just absolutely not the case. With a reverse mortgage, the borrower does, the deed stays in their name. And as long as you're paying your property taxes and taking care of the house and keeping your homeowner's insurance, you're absolutely remaining in the home, indefinitely. Wow. The next thing would be that the reverse mortgages don't allow you to make payments, but as I alluded to earlier, you absolutely can choose to go ahead and make payments. If you want to go ahead and do that, like I said, you're essentially kind of preserving the equity. And we'll talk about circumstances that actually that might be a good idea. The next one would be that the heirs would be responsible for all the debt that the borrower basically utilized through the time. And that's not the case. A reverse mortgage is a non-recourse loan, which simply means that even if the borrower remained in the home and let's just say they lived beyond the expectation of the original lender and continue to receive monthly payments for the remainder of their life, well beyond the value of the house that they originally calculated, the family members, the heirs, are not responsible for paying anything over the actual value of the house. So no, that non-recourse feature is very, very important, and it protects the borrower and certainly the heirs. The next one would be that it's a loan for people that have their house is paid for, but they're cash poor. They're desperate for money, and that's actually not at all the case. In fact, if you look at the numbers, today's reverse mortgages are actually more utilized by people that understand the ability to go ahead and utilize an untapped asset, specifically the equity in their home. Equity, you can't spend it like money. In fact, it really isn't only available unless you do a cash out refinance. Of course, you now have a loan that you have to pay back on a monthly basis. Or you sell the home, which unfortunately now you don't have a place to live. So the reverse mortgage is in a very unique position there, where essentially you have access to the equity, you don't have to pay it back. Again, we've got options, and we'll talk about those. The last one would be that the reverse mortgage cannot be gotten rid of. That you have this thing for life and you're stuck, and that's absolutely not the case. You can refinance out of your reverse mortgage just by paying back the benefits that you've utilized up until that time. You can pay it off with a refinance into a conventional mortgage if you wanted. You could sell your house and just pay it off. There you go. You can even refinance your reverse mortgage into another reverse mortgage. So there's no validity to those claims that you're kind of stuck with this. That's not the case at all. We do want to just kind of remind you, though, one thing that is responsible is that the borrower needs to go ahead and continue to take care of the property taxes, take care of the home, make sure it's safe, as well as keeping up on their homeowner's insurance. The proceeds aspect of reverse mortgage, we'll break it up into two. The amount of proceeds that you would receive is essentially based on 4 different factors, and that would be the age of the youngest borrower. That would have a bearing on how much you're going to be able to receive, and we'll talk about that. It's very specific, obviously. The next one would be the value of the property and the equity position in the property. We're trying to figure out what's available to go ahead and utilize for future usage as far as the borrower through time. The next one would be the actual current interest rate at which point the loan is originated. And then last is the 2 different types of loans. We have a governmental loan that is the kind of staple, the standby. And then there today are kind of variations that are a little bit more flexible. So those 2 different types of loans actually may have a different approach to how much proceeds you're going to receive up front or throughout the course of the loan. But as far as once you decide how much you're going to get, now we just need to make sure that you're going to, pay off any mortgages and stuff like that, any liens against the property. You certainly want to make sure that the property taxes are current and stuff like that, and the loan closing costs are taken care of. And beyond that, again, the homeowner's insurance is current. Beyond that, the option is up to you. You can actually receive those proceeds in 3 different methods, technically kind of a fourth. You can actually receive it in a lump sum, all cash, upfront, all at once. The next one would be to receive a monthly check deposited into your bank from the lender, month after month, year after year. The third one would be to actually go ahead and open up a line of credit where all those available funds are there for you to be utilized at any time, but you just go ahead and choose whether you use them or not. And we'll talk more specifically why that might be the route to go. And then the fourth one, as I alluded to, is there's actually a combination. So you can potentially have funds up front and then go with the monthly payment for the rest of your life, for example. The next one would be the borrower's responsibilities. Now, it is a loan, and just like with any other loan, it's got to be paid back. But unlike traditional loan, the only 4 reasons would actually require reverse mortgage to be paid back. And the first one would be if the borrower sold the home. Obviously, you retire the home, you retire the loan, it gets paid off. Easy peasy. The next one would be if the borrower no longer occupies that home as their primary residence anymore, which can happen if a person potentially maybe goes into a long-term care facility and they have no reasonable expectation to be coming back to the property. Then you would actually start making arrangements to go ahead and retire on that loan. We can talk about some of those options. The next one would be if the property is not maintained, it's not a healthy place for a person to to habitate in any longer. If the property taxes are not paid, or if homeowners insurance has been let go, it's not current. That would actually cause the need to go ahead and do something else because this approach isn't working out. It's not safely taking care of the borrower. Beyond that, the last surviving borrower, once the last surviving borrower passes away, then that would be another scenario in which that reverse mortgage would need to go ahead and be addressed. And again, we could talk about the timelines and stuff like that for each of those different scenarios. Beyond that, appreciate, we talked about the repayment aspect of it. The nature of a non-recourse, the nature of that when it comes time to pay back this loan, it's only going to cap out at the value of the property. So regardless of how much funds that the borrower was able to go ahead and maybe exhaust, the lender beyond the value of the home, it's not a consideration. In fact, it's designed to actually take care of that. It's not that you need to feel bad about. In fact, that would almost be viewed by some people as a success. But the reality is the heirs or even the borrower, if they were to sell their home, they're only going to be responsible for paying back at the most the total value of the home. So, got to appreciate them. And anything beyond that, that actually comes back to the borrower. So, for example, they've utilized maybe $600,000 in usage of the reverse mortgage through the years, but they sell their house for $1 million. Well, that $400,000, of course, is going back to them. That is still their net equity that just wasn't touched. So, looking at the next one would be the actual safeguards. It is true that those myths behind the reverse mortgage, they may be rightfully deserved because there were some horror stories going on some quite a few years ago. The laws have changed to, in my opinion, better protect the borrower, and some of the four I'm going to touch on here kind of extend from those changes. The first is, as far as safeguards, that the borrower must go through a third-party counseling session so that they fully understand, exactly what a reverse mortgage is, maybe compared to what they're typically expecting, as far as a loan. It has very unique aspects to it, and the borrower needs to go ahead and convey to the lender that they understand that. The next would be the notion of a no prepayment penalty. As I've said, you can get out of this loan at any time, and it's not punitive in doing that. So if you do want to go ahead and get out of it, maybe you meet somebody and you want to go off in a different direction with this new individual, you just sell your house, pay off the loan, and life goes on. The next one would be the non-recourse loan, which we've touched on already. Again, that's a huge safeguard so that people, especially the heirs, are not kind of caught off guard with this big old loan balance. No. You can actually determine at any given time what the payoff would be, but it's never going to go over the value of the house in any case. So, and there's also, I mentioned that we need to ensure that the property taxes are taken care of and the homeowner's insurance is taken care of. You have the option, when you find out what your proceeds are, you can actually set aside a small amount, and it's called a life expectancy set aside. And it is this little amount that's set aside that will actually go ahead and pay your property taxes and your homeowner's insurance month after month, year after year. So you don't have to actually, put any thought towards it. Just know that it's taken care of and the funds are set aside to go ahead and do that through time. So again, another safeguard that was built in just to ensure that that nothing goes astray. People aren't caught off guard and everything is essentially, available to them from day one and every day beyond that. As far as the types of the reverse mortgages, I mentioned there are two. The first original product, that HECM, that home equity conversion mortgage, there is a fixed HECM as well as an adjustable HECM. They are both FHA products. They're both a government product, which is cool. The HECM has a max borrowing ability up to $1,089,300. So if you're having a home or a value, or if you want to go ahead and maximize the available proceeds, and your house is worth quite a bit more, maybe the HECM may not fulfill your needs. You might be looking at the proprietary one, and we'll talk about that in a moment. The minimum borrower for a HECM in both the fixed as well as the adjustable is 62 years old. So if you're younger than that, it may be an issue. It's worth having a conversation. There are some variances there depending on spouses and stuff like that. So we'll talk about that. And then again with the HECM adjustable, there is no minimum score. It's not that you have to qualify for it, so they're not going to be looking at your FICOs. There is a purchase as well as a refinance option for the adjustable. And this is the one that actually allows for that line of credit. The line of credit is very, very important because it allows that any unused line of credit to actually expand over time. So you may start out with, say, $400,000 in a line of credit, but you don't utilize the credit. You just don't use it. Well, again, it's a reverse mortgage, so things kind of, and I'll get more specific when we talk, but in a traditional mortgage, you pay an interest rate on what you've used. In a reverse mortgage, you still have an interest rate, but if you don't use that asset that month, you can see where actually your line of credit would actually get larger through the non-use of a line of credit. It's brilliant. It is because of this that if you did absolutely nothing, in theory, the longer you don't use this, the more available, usage you have moving forward, years and years ahead of you and stuff like that. So it's a huge feature. It also can allow for, if you did use a line of credit, maybe you have a specific, investment strategy that pays out a certain, rate, then you might want to go ahead and just say, I'm going to go ahead and use my line of credit because I have this opportunity to make, 13% here on this particular, investment. That is what people essentially are using these reverse mortgages for, because again, it's equity, and you can't cut a check with equity, but you can with a line of credit utilizing reverse mortgage. Also, appreciate that line of credit, if you did use it, you can, and probably will, just come right back and pay it back down. You can pay it off to nothing. You can pay it off. You can just like any other line of credit. And if you do pay it down, again, it starts that feature again with the unused line of credit actually allows for it to actually grow through time. It's quite brilliant, actually. The next would be that fixed. Pardon. The HECM fix does still have that $1,089,300 for a maximum value. Again, the 62 years of age, no minimum credit score. But in this particular case, it might be used by the HECM fix because you have a loan that has a large principal balance. So say you have, even today, you have a principal balance of $650,000 on your primary home. And that's a major stroke. And you don't want to go ahead and make those payments through time moving forward. You might want to consider using the HECM fix because you can take it all up front, all at once, pay off that larger, first mortgage that you currently have. And then, moving forward, you do not have a mortgage payment, going months and years into the future, which is awesome. There's also, some other options. Maybe if you had some other outstanding, large debts, maybe the HECM fix might want to be the approach that you go. It's up to you. There is, however, the proprietary loan and several larger reverse mortgage lenders out there across America do provide something similar to this. They're pretty similar. The SmartFi proprietary is called the Choice. And this one allows for a maximum value of up to $4 million. So if you have a larger estate, you want to go ahead and find out about how much proceeds you have access to with that large of estate, you can see where that SmartFi Choice would be maybe a better choice. no pun intended, than that HECM, simply because it has a little bit more flexibility. It has more flexibility on the ages as well. And under circumstances, the youngest borrower can be 55 rather than the traditional 62 required for the HECM. And that's specific by program and state, so we can talk about that as well. The next thing would be that whereas the HECM is an FHA product, the FHA does have mortgage insurance for life. So there's going to be, this portion each month you may utilize those benefits, unless again we're looking at the line of credit, where the mortgage insurance is going to be deducted. That's not the case with the choice product, no mortgage insurance. But you can, however, in this circumstances, again, more flexibility, you can use the proceeds that you're going to receive after the reverse mortgage closes. You can use those funds to go ahead and pay off the debt that you need. So they will go ahead and calculate, assuming that debt's going to be retired through the proceeds, as well as you can actually use the incoming benefits to qualify for any income requirements. Because again, remember, you need to actually show that you have the ability to go ahead and pay for the property taxes, the ability to go ahead and pay for the homeowner's insurance. And you can actually use the newfound funds, if you will, to go ahead and qualify for that need. So again, it's quite unique in the way it's set up to go ahead and resolve problems. As far as the requirements, looking at the two, again, they're similar. You have to go to counseling for both of them. You must complete kind of a financial assessment, if you will. We're not talking about FICO scores just solely, but they need to ensure that you have an ability to go ahead and make payments for those homeowners insurance as well as the property taxes. But again, with the HECM, 62 years and older, whereas the choice product, the proprietary product, that would be 55 and older, so there's a little more flexibility there. But in both situations, it needs to be your primary home. Reverse mortgages are not available for investment properties. Typically, at this point, we would actually talk about your actual specific scenario, your home value, your needs to go ahead and whether we be looking at receiving a monthly payment, a large lump sum, or perhaps looking at a line of credit, and we can do that. But right now, math, giving an example, is probably not going to work out too well on a video, so we can handle that in person. I want to go ahead and start wrapping this up. Ultimately, the common goals between both of these loan programs is just essentially financial security. You're utilizing an untapped asset, equity. And you're using that as a way of ensuring that you have adequate cash flow, that you have a portfolio perhaps that remains healthy through time, as well as maybe, let's be realistic, long-term care needs might be or you want to remain in your home for long-term care, because again, it needs to be your primary home. So that would be a wonderful opportunity to go ahead and use reverse mortgage. Beyond that, you can actually buy a second home with the proceeds. It's not like there's the proceeds police with these types of loans, but certainly so the flexibility of all of these things kind of gives you the freedom to go ahead and enjoy whatever you may want to use the funds for. Looking at the three types of broad categories of folks, some people use these just simply because there is an immediate need. We just talked about one. Maybe it's a health concern and stuff like that. Maybe you just want to ensure that you have the living expenses to go ahead and address those. And that would be a very straightforward cause for the immediate need. Some people have not a need, but maybe a want. Maybe they want something in their lives. It's retirement, and you've done all this, and now it's your time to actually live a little. And they may want to go ahead and use a reverse mortgage to make those things happen. Maybe they want to rehab their house. Maybe they want to rehab their house, make it easier for them to kind of be mobile within their own home. Again, reverse mortgage funds can do all those things. The other person that need was maybe they actually do have funds for retirement, but they want to hold on to those funds, just in case something happens, and have a reverse mortgage kind of helps supplement the fact that you already have a retirement in place, but you may want to go ahead and hold on to those just in case. That would be a need. And then the third person I've alluded about, that would be that line of credit. Some people, they actually are just using reverse mortgages just as kind of a financial plan. It gives them an asset to go ahead and use to make money, whether that would be in a particular investment strategy or whether they're going to just simply use an untapped line of credit to go ahead and expand their ability. Because otherwise, that equity, granted, you can go ahead and make a little, more value through appreciation, but it's not as if you have access to that value. It's still stuck into equity. So the reverse mortgage does give a strategic financial plan that just wasn't there before. With that, always talk to your financial professional, and I'm sure they're kind of used to having a conversation when people bring up reverse mortgages. So I encourage that call to your financial planner, and I'd love to actually find out about the outcome, because it kind of makes me feel better about the services that I offer. So just as a highlight, it is a loan that allows for a person to not make a monthly payment on their primary home if that's what they choose to do. It allows certainly to have that borrower remain in their home, to hold on to their deed. Like I said, the myths behind all of this. Wow. Granted, they did make a lot of changes in the laws some years ago, and it's unfortunate those things did happen. That is not the case today. Everything is very, very upfront, very, very specific, and I'd like to talk to you about those. Beyond that, appreciate that any funds that you use are tax-free. Again, this is not an investment property that you're living in. This is your primary home. The funds that you use to acquire it already paid their taxes, so any funds that you do utilize are tax-free. So anything you may do with it isn't necessarily going to cause a tax liability or a taxable event. You're using tax-free funds. And again, that non-recourse feature just ensures that at no point are you going to be kind of kept, found out, all of a sudden that you owe this huge amount. You're not quite sure why. That is just not the way that this loan is designed. It is a loan, it is a tool, it is an ability for folks to go ahead and use an untapped asset, their equity. You folks have your own equity position, your own needs, your own reasons to consider a reverse mortgage. So I would hope that maybe just go ahead and listen to this, take a look at my website, a portion of the reverse mortgage. Give me a call. Definitely talk to your finance person to ensure that everybody is on the same boat. And I would welcome even a return call. Just let me know how that call turned out. My name is Corey Mason. My company is Home Again. Certainly able to go ahead and answer your questions concerning loans specific to reverse mortgage. I would love to have that conversation. 805-710-9060. Thanks so much.